What's the latest?
Hi, Paul. We've got a bunch of recommendations that range from mid-cap stocks to rare earths to gold, of course, high-grade corporate bonds. And, you know, in our how do I put it, out-of-the-box recommendation is a proposal to invest in a music library. Now, like I said, gold is pretty much on everyone's recommendation list, even now when we have 4 experts in that piece, which is a very popular read here in India. But otherwise, the strategies seem to range from, let's be cautious, there are challenges yet, and the other side is the worst is behind us. I have someone from the former camp, Bhautik Ambani. He's the CEO of AlphaGrep Investment Management, and I think he is advocating a significantly cautious stance. Why is that, Bhautik? Your portfolio strategy, as quoted in the piece, is not exciting, not flashy, but sensible.
Thanks, Menaka, for having us here. See, to be honest, what we are seeing today is what is being told to us by our data. We're a quant-focused house, so data speaks a lot more to us, and we just follow what the data tells us. To a certain extent, what we can make out of this data is, at this point in time, we've had a phenomenal run over the last few years in the Indian markets. And to a certain extent, we believe that the valuations have kind of run ahead of its time.
Even now?
Even at this point of time, like we just heard Alex.
We've seen a significant time correction.
We have. Having said that, we just heard Alex, right, saying that we've seen Nifty 50 earnings growth go up by around 10%, but we're still paying more than 20 times for that, right? The other anecdotal data is, if you think about it, you're still having foreign investors either not putting in money in Indian markets or they're still continuing to pull out, right? So in some sense, you're seeing professional investors not look at Indian markets yet, right? Bulk of the emerging markets have continued to do well, despite that India has been lagging entire 2025. And I personally believe, or at least our data tells us, that we're going through some kind of a regime change, a structural regime change in the markets. And that's thanks to what we're seeing globally.
What does that mean, a structural regime change?
Structural regime change is, when you are seeing fundamental changes in the market, which can be thanks to, let's say, policy changes globally. We are seeing divergence around that. We are seeing divergence around what we're seeing with metal prices, right? We had seen like a phenomenal we had seen a long period where metals didn't do well in India, or even global markets for that matter. In the last couple of years, we've seen them do well, including gold, silver, and a lot of other non-precious metals as well. We're potentially going into a phase where we might see a structural bull run in the metal space as well. Okay. So if that's, and geopolitics, right? Like, we're in the midst of it right now.
Yes, and we woke up to the Iran headline this morning, and oil price is much higher.
So there are multiple things which are happening out here which can potentially lead to some kind of a regime change in the markets, right? Okay. Now, when something like that happens, what one tells you is that whatever's kind of working in the last few years may not be the same, which will kind of continue to do well going forward.
Okay, let me get a little bit more specific. You mentioned 2 things, valuations and the return of foreign investors, which is yet to happen, only happening on the margin. Right. But they are, in some sense, contrary to each other, right? Because if foreign investors do come back, in fact, prices will only just go up. And so your valuation argument then gets defeated. So what would you prefer, or what would you like to see change for your position to become more aggressive? Let's say on equities, which right now you're recommending should be just 20% of the portfolio.
Yeah. So I think, from our perspective, we can change some of these stances very quickly. Right, so it's not that we're only looking at fundamentals. Right. So the way our model works...
What needs to happen in the market to change for your stance to change?
Sure. So again, like I'm saying, that from a market perspective, what we would like to see is, some kind of convergence between where valuations are today, right, and with where the prices are, right? So if that converges to a certain extent, then that will probably make us change our valuation or change our stance in terms of taking a higher allocation to equities. Because at least our model tells us today, from a risk parity perspective, fixed income is making more sense compared to equities, as per our model. And that's the reason we are more tilted towards fixed income compared to equities as per our model.
Okay.
Right?
In equities, you've recommended relatively safe plays, large cap stocks, and safe mid cap.
Right.
some of the other conversation in that story seems to suggest that consumption might be a good place to be in. Is that something that you see reviving significantly?
So consumption, to be honest, hasn't done that well in terms of price move. We've seen a lot of other sectors which have done well in the last few years. So that is something which is a safer bet to take at this point in time and may kind of do well going forward. And one of the triggers for that is obviously the GST cuts that we've seen a few months back. Right? So that can lead to that.
So what do you like in equity? Very quickly, because I want to ask you a quick last question on that.
Sure. So from an equity market perspective, today we would just stick around. I mean, I'm not taking a sector bet here right now.
Okay.
I would just stick around with more large cap names or safer bets at this point of time in the equities.
All right, a quick final question on debt. 60% allocation is what you've recommended. Again, another recommendation seems to suggest 1 to 5 year high grade corporate bonds is where your money should be. Is that how you're viewing it?
Very similar. I would stick around with AAA names, safer bets at this point of time. Like I said, overall view is cautious. I think it's not stemming from what's happening in India, but I think it's what we're seeing globally as well.